You know, right now in the Bitcoin market, it's like we're watching two completely different movies at the same time. One story is all about this massive long-term bull run that's structurally in place. But the other one, it's flashing some really serious short-term warning signs. So let's dive in and unpack what's actually going on.
So it all comes down to this one question. Is Bitcoin gearing up for this incredible, bright future, or is it about to walk right into a nasty, bearish trap? In this explainer, we're going to look at both sides of this puzzle, using the data to see where the real opportunity might be hiding.
So you've got this one camp, right? They're looking at these huge, long-term, fundamental drivers that are pushing Bitcoin up. But then you've got this other camp, and they're staring at the charts right now, and what they see is a big red warning sign of a sharp drop. The real question is, how can both of these things be true at the same time?
All right, let's zoom out. First, let's talk about that long-term bull scenario. We're not talking about what's going to happen next week or next month here. Nope, we're looking at the massive undercurrents, the big waves that could define Bitcoin's value over the next year and maybe even longer. So when you look at professional analysis, it really points to three key things holding up this whole optimistic view. First, what's happening in the global economy. Second, Bitcoin's built-in scarcity. And third, the fact that big institutions are finally really jumping in. Let's dig into each one. First off, the whole economic landscape is changing. That period of central banks jacking up interest rates to fight inflation, yeah, that's pretty much over. Now, especially in the US, they're starting to signal they're going to ease up. And what that means is more cash, more liquidity is about to get pumped back into the system.
And look, this isn't just a guess. The numbers back it up. We're seeing projections that the US Fed is going to be cutting rates quite a bit through 2025. And history tells us, when the returns on safe stuff like bonds go down, investors start looking for bigger returns elsewhere. They get a bigger appetite for risk, and that's usually great news for assets like Bitcoin.
Okay, pillar number 2, scarcity. And this number, this is just wild. 95% of all the Bitcoin that will ever exist has already been mined. And that last 5%, it's going to take over 100 years to get it all. We're talking about scarcity that's literally programmed into its DNA.
You know, there's a really powerful way to think about this, and it comes from this analogy. Bitcoin isn't just some computer code. Its programmed scarcity gives it this quality, this uniqueness that's almost like having a digital Mona Lisa. It's one of a kind. And this scarcity isn't a one-time thing. It gets reinforced automatically by something called the halving. Basically, every 4 years or so, the rate at which new Bitcoin is created gets sliced in half. Think about that. The flow of new supply is programmed to slow down over time, which in theory makes the existing supply that much more valuable.
All right, so we have a good macro environment, we have scarcity, but is anyone actually using it? Well, that's the third pillar, real-world adoption. And this isn't just people betting on the price anymore. Look at this. After some new regulations in the US, the use of stablecoins for actual payments for goods and services shot up by 70%. We're talking about real companies using this tech to move money around the world, skipping the old, slow banking system. That's real utility.
Okay, so that's the beautiful, long-term story. It sounds great, right? But now we got to zoom way in and look at the immediate danger. Because while that big picture looks pretty sunny, the short-term chart is flashing some major warning signs.
So what's got everyone so nervous? It's this one technical pattern called a bear flag. And you don't need to be a Wall Street trader to get this. It's basically a pattern that shows up after a big price drop. The price takes a little breather, kind of goes sideways, but it often signals that another big drop is coming.
So why is this bear flag such a big deal right now? One word, leverage. People are making huge bets with borrowed money. Just look at this imbalance. You've got over $2.2 billion betting the price goes up versus only about $500 million betting it goes down. That is a massive 4-to-1 lean in one direction.
And that imbalance is absolutely critical. Think of that $2.2 billion as a giant pool of gasoline just sitting there. It creates this huge financial incentive for big players, whales, to push the price down just a little bit. If they can, it triggers all those bets to automatically close, which forces more selling, which triggers more selling. It's a domino effect, a cascade that can tank the price really fast.
And if that wasn't enough to make you nervous in the short term, look at this number. A net outflow of almost $3.5 billion from the spot Bitcoin ETFs in just 1 month. Now on the surface, that looks really bad, right? It looks like the big money is running for the exits. But hold on, here's where the context is everything. The analysts looking at this don't think it's a sign of panic. What they see is something much more normal. It's smart money doing what it does. After a great run, institutions are just taking some profits, rebalancing their books before the year ends. It's a strategic move, not a get-out-now signal.
Okay, so with all this going on, what are the actual numbers to watch? These are basically the lines in the sand for traders. If we get above 95,900, the bearish risk is pretty much off the table. But if we break below that critical 89,100 support level, that's what activates the bear flag. And from there, the first target is around 80,500 with the max pain, worst-case scenario drop all the way down to 66,600.
Okay, so how in the world do you make sense of this? You have this amazing long-term story and this terrifying short-term risk. This is where you have to put on your cool-headed, strategic investor hat. Because the key is understanding that both of these stories can be true at the exact same time.
And this is the key takeaway from the professional analysis. It completely flips the script. That potential short-term drop, it's not a disaster. It's a strategic, liquidation-focused buying opportunity. It's a chance to get into that long-term bull market at a discount.
Yeah, from this perspective, a big drop is actually a good thing. It's healthy. Its goal isn't to kill the bull market. Its goal is to cleanse the system, to wash out all of that excessive, risky leverage we talked about. It builds a much stronger, more stable foundation for the next leg up.
So what does this mean for an actual strategy? Well, it splits it into two timelines. In the medium term, say the next 3 to 12 months, you got to be cautious. Expect things to get rocky and definitely avoid risky leverage. But for the long term, over a year, the view is still very bullish. Those potential drops to 80,500 or even 66,600, those aren't points of panic. They're potential entry points.
And this really sums up the whole conflict, doesn't it? It's two completely different mindsets. You've got the short-term fear, which is all about chart patterns and leverage, and it causes people, what they call weak hands, to panic sell. And then you have the long-term conviction, driven by fundamentals and the big economic picture, that sees that panic as the perfect time to buy. Which brings us right back to where we started. The Bitcoin market right now is a tug-of-war between these two massive forces. So, in the end, what's going to win? The short-term fear or the long-term opportunity? And that right there is the billion-dollar question.